From New York City for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. Coming up, consumer sentiment sinks for the first time since April as inflation expectations rise. The data putting a damper on a solid retail sales print, with price pressures showing up in this week's PPI report. And the great rate debate heats up. What should the Fed do at its meeting next month? We begin with the big issue, inflation concerns coming front and center.
Inflation is alive and well.
We're sort of in a stagflation-light environment.
We've been calling this environment stagflation light.
Stagflation still is an issue.
Growth is slowing down.
The economy is slower than people think.
The economy is going to be slower in the second half of this year.
We see the economy flattening out here.
You have the scope to cut by 50 basis points.
To me, that seems like a lot.
Could we get there? Potentially, but I think we're going to need the data in order to justify that.
Absent us falling into a significant recession, the Fed doesn't really need to cut.
We expect them to cut, and not only in the September meeting, but probably another 100 basis points or so this year.
There is no urgency about cutting rates. Now, I think they will cut rates for political reasons. Just because the Fed eases, let's watch what the bond market does.
I think we need to see what things look like as we get into September.
Boy, what a range of expectations right there. We'll take a look at the most recent inflation expectations print that we have, the University of Michigan Sentiment Survey this morning, showing consumers expecting inflation to rise for the first time since the spring. Remember, we had that huge uptick in inflation expectations. It caused all sorts of market ructions because, obviously the Fed wants to keep inflation expectations anchored. Well, now we have maybe something a little worrisome again. This is the 1-year inflation expectations from consumers. This is 5 to 10 year, obviously both rising in sync. We're obviously not at these levels, but we're well above where we were when, life was a little maybe simpler. Let's flip up the board and have a look at where the 2-year has been trading all week, because we've been seeing it in a range of about 12 basis points. We were as high as 377 practically and as low as 366. As the market continued to reprice what it expects from the Fed September 17th. So remember, we had the benign CPI data that caused some relief, and then we had the less benign PPI data, which caused a little bit of repricing once again. So we're going to dig into all of this with our guests today. Meanwhile, U.S. Treasury Secretary Scott Bessent spoke this week to Bloomberg as well, and his comments on rates also certainly got the attention of everyone.
We should probably be 150, 175 basis points lower. So, I think the committee needs to step back. I think probably one of the most politicized governors just went off the board.
Joining us now, Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research, and Kelsey Berro, Fixed Income Portfolio Manager at JPMorgan Asset Management. Kelsey, let me start with you and the Treasury Secretary's comments, which he indeed walked back and sort of said, no, I was talking about where the neutral rate should be. I mean, what if the economy were experiencing rates that were 1.5 to 1.75% lower right now? What would it be doing?
So that is essentially the question of where is the neutral rate. So if you do cut rates 100 basis points, how much stimulus are you expected to see? And I think it's fair to say and important to recognize that no one really knows where the neutral rate is. We're all essentially examining it in real time based on the data. And so what I see in the data today is that the current level of policy rates, which is 4.25 to 4.5, is modestly restrictive. It's more restrictive in certain parts of the economy, like the housing market, like for anyone who is buying big ticket items and financing those big ticket items, like an automobile. And then in other areas of the market, it does not seem to be as much of a challenge. So if you think about financial conditions indices, they have continued to ease. And, for those who are looking to borrow money in the public corporate bond market, for example, the market is essentially wide open for them. So it's a mix of views. But what I can say is that I do feel that the current policy rate is still modestly restrictive.
Yeah, Kathy, let me come to you now and ask you pretty much the same thing. I want to point to John Authors of Bloomberg Opinion writing this week saying this is breathtaking with the current effective Fed funds rate at 4.33. He, as in Bessent, is suggesting that it should be about 2.6%. Over the last 70 years, the rate has never been that low, with inflation as high as it is currently. What are your thoughts on where the neutral rate is right now?
Well, I'd agree with Kelsey. We're all trying to figure out where the neutral rate is, but and I'm not really sure where the Treasury Secretary got that estimate, because there's nothing that I can see in the data that would suggest we need rates slash that sharply. And in fact, I think that that would be fairly inflationary, both on the asset price side and on goods and services. So it's really difficult to make a case for that big a cut in rates, unless you're really looking for the economy to fall off a cliff. I do think that there's room for a 25 basis point rate cut at the September meeting. That's kind of been our call all year, because we think that the impact of tariffs and some of the federal spending cutbacks will work their way into the numbers, particularly the employment numbers, by the fall. But going much beyond that, maybe another 25 by the end of the year, we really have to see the data play out in such a way that consumer spending really continues to slow down, where hiring gets much weaker than it already has, and or the unemployment rate moves up. And I'm not convinced any of that's going to happen. So 25, maybe another 25 by the end of the year, but 150 or so, I have no idea where that comes from.
So the data this week, you know, much as we saw PPI be a little bit, you know, dangerous or maybe a red flag, you're not concerned so much about the labour side of the economy, about the consumer weakening, about all of the corporate earnings that we got that suggested that some consumers are skipping breakfast and things like that?
Well, I do think the economy is slowing down, and that's why a 25 basis point rate cut in September and probably another one by the end of the year makes sense. But the offsetting factor is, unless that unemployment rate really moves up or hiring really goes into negative territory, it doesn't look like consumer spending is falling off a cliff. So we saw the retail sales numbers today, not bad numbers. And when we look at the inflation side of the argument, a lot of the increases are still in the service sector side, and we're not getting as much offset on the goods side. And we've had a 10% drop in the dollar. That's going to feed its way through in import prices. And in fact, ex-petroleum import prices were up 0.3% for the last month, and that's the highest we've seen in a year. So there's a lot of components here where, although we see slowing in the economy, and we do think that that will influence the Fed to cut rates, we don't see the cycle playing out for a series of rate cuts absent a real decline in the labor market.
Yeah, Kelsey, we were just looking at the chart there that showed traders pricing out just, you know, ever so slightly the prospect of a rate cut in September. Is it a done deal?
So it's not a done deal. I would say the most important data point between now and the next Fed meeting is the next payrolls report. So I think, Kathy, I agree with the assessment that, you know, the really big game changer for the Fed and for this market would be if you start to see material increases in the unemployment rate. Because right now, the market is looking at an economy that's slowing, consumption that's slowing, payroll growth that's slowing, but there's enough ambiguity about why it's slowing, and if that slowing is going to continue, that it's not necessarily causing the Fed to need to move more aggressively. And I think what changes that is if you see an increase in layoffs, an increase in claims, an increase in the unemployment rate. But I think if we get a jobs report for the September data point, or for August, that is essentially consistent with the current trends, the Fed is going to deliver on that 25 basis point rate cut.
Kathy, we have Jackson Hole next week. Typically, it's, you know, well, I shouldn't say typically, you know, there have been times where it's been a non-event, but there have been plenty of times where it's been an event as well. What kind of message do you think the Fed chair will want us to take away?
Yeah, that's a great question, because I don't know what to expect from Powell at this one. I think he'll want to be consistent with his recent statements, saying that they're balancing the dual mandate, and right now they're still further away from their inflation target than they are from their unemployment target. That being said, I think he also wants to open the door to the possibility of a rate cut in September, because I do think the last labor market report was probably a game changer for the Fed. You've certainly heard some outspoken members of the Fed talking about rate cuts after that, and I think it probably will sway them in favor of a rate cut. So he wants to leave the door open to that. But I also think that this is Powell's legacy, and he doesn't want to be going out with inflation elevated and looking like they've abandoned their inflation target. So my guess is he'll walk a line, open the door to rate cuts, but also concede that, the future is still uncertain and they're waiting to see the full flow through of impact from tariff policy and some of these other federal policies that have taken place have created a lot of volatility in the numbers, a lot of volatility in terms of just expectations. And I think that there's a good point on those consumer expectations numbers. The Fed does watch inflation expectations pretty carefully. And although survey data can vary a lot, and we know that there's some issues with that, but we're not really seeing the inflation expectations numbers come down to a level that probably gives the Fed a lot of comfort in terms of going forward. So I think he'll try to walk that line.
Same to you, Kelsey. Jackson Hole next week, what are you anticipating?
Right. So I think that what Powell would ideally like is for his comments to not necessarily move the markets and let the markets reprice the probability of a rate cut based on the data flow itself. So it's not about what people are calling for in the White House or at the Fed. It's what the data is going to guide them to do. And so when you saw the market reprice after the last jobs report, that's what brought us from, 50% probability of a rate cut in September to close to 100% probability of a rate cut in September. And that next jobs report, that's what's either going to keep us at 100% probability of a rate cut in September or cause people to question the necessity of a rate cut. Because really, what has shifted in terms of the Fed's reaction function most recently, it's not that their base case has changed. I think that they continue to have the same base case view for the U.S. economy. It's the risk management. So essentially, they were more concerned about inflation a few months ago. Now there's a possibility that they need to be more concerned about the labor market.
Amazing. Kelsey, thank you so much for joining. That is Kelsey Berro of JPMorgan Asset Management. And our thanks as well to Kathy Jones of Charles Schwab. Remember, the Fed chair speaking next Friday at 10 a.m. behind closed doors. Up next, the auction block. Falling yields, strong demand and robust earnings helping to drive a supply boom in high yield. We talk credit next. This is Real Yield on Bloomberg. I'm Bonnie Quinn. This is Bloomberg Real Yield. It is time now for the auction block, where we look at credit issuance for the week and the month. Monday was the most active day in terms of number of deals and volume in 3 months, but sales were still around $9 billion short of dealers' full week predictions. This week, you had sales from the likes of Chevron, CVS and Merck. In high yield, the supply boom persists, with August having its busiest start since 2021 with more than $25 billion worth pricing. The company Block contributing to nearly $5 billion sold on Wednesday, the busiest day since June 5th. Repricings helping fuel July's record for new loan issuance. And in August, which is typically a slow month, we're already at a record for leverage loan launches. That is even with a slowdown to close the week. When it comes to credit, Priya Misra from JPMorgan Asset Management told me that fundamentals are still strong.
High quality spread product make a lot of sense because we look at company fundamentals. Even the consumer fundamentals are strong. Low-end consumers are struggling, but the majority seem to be doing okay. So staying up in the capital structure and then owning duration as a hedge. I think it's clear from the Fed, if the economy slows down, if you see a negative jobs number, they're cutting a lot more aggressively. So I think duration will be a hedge. Owning some duration, having some curve steepness, and then owning spread product because we're in a soft landing.
Now with us is Amanda Lynam, head of macro credit research at BlackRock, and Maureen O'Connor, global head of high-grade debt syndicate at Wells Fargo Corporate and Investment Bank. And thanks to you both. So let me start with you, Amanda. How are we in such a healthy environment given the amount of uncertainty that's out there and the repricing that we're seeing, particularly at the short end, every day.
Yeah, good afternoon. Thank you for having me. I think it's really this focus on this back to basics credit work on the corporate sector. And if you actually dig under the surface, yes, there's a healthy amount of dispersion, but most corporates are navigating this period with a degree of resilience due to a myriad of operational levers at their disposal. Couple that with the solid fundamentals that Priya mentioned at the start. You've got favorable technicals on the supply and the demand side. And actually, it's a complex mix and certainly dynamic, but I think really it leaves us comfortable with our view to selectively move down in credit quality, and we're not shunning credit risk at this time.
You're happy to move down in credit quality. Maureen, you're staying at the high end, right? Is there anywhere around, the high grade that you're a little concerned about? Are you seeing any pockets of fragility?
Yeah, so my coverage universe is the investment grade space. And as Amanda rightly points out, the demand dynamics are robust across the rating spectrum and across the curve as well. Some of that has to do with some of the supply technicals. We've had a very light issuance summer, which has helped bring spreads back down to what are now cycle tights. I would say, when you get to this very rare, very tight valuation level like we're in right now, idiosyncratic risk does start to pick up. So under the surface, if you look at some of the more cyclical sectors, they have not necessarily participated in this huge recovery that we saw from the widening pressure back around Liberation Day in Q2. And there are some more tariff-exposed sectors, for example, that perhaps, come under a little bit more pressure in this environment. So said another way, I think avoiding some of the losers is as important as picking some of the winners in this environment. But as a whole, we're still pretty sanguine on the outlook for spreads here. Technicals are exceptionally firm, and fundamentals, as you rightly point out, we're kind of at the peak of the credit cycle here. So I think there's a lot of reasons to be positive about the path of spreads.
Yeah, I mean, if you look at the index, we're talking about sub 5% now return for investors. I mean, is that enough for the amount of risk they're taking? Because, yes, we had a great earnings cycle and corporates do seem to be in good shape broadly, but surely there are risks from tariffs, geopolitical risks, and all sorts of other things out there.
Yeah, well, I think it kind of depends on what type of return you're trying to generate by investing in the investment grade bond market. The investor base is quite diverse. We've actually had a pretty positive returning year for the asset class. We're up over about 5.5% from a total return perspective. And so we've seen a lot of new cash come in through ETF and mutual fund flows into our market. So you have that dynamic underpinning our market. But really, the predominant buyer of credit that's been pretty pervasive since the start of the tightening cycle back in 2022 has been the yield-based buyer. It's the asset liability managers, pension funds, insurance companies. Well, still, as we've dipped lower in yields, 5% or roughly 5% at the index level is still an attractive entry point for a lot of these investors. And the long end of the curve from a supply perspective, it's actually been the most undersupplied. So there's just not a lot of product for these types of asset managers to buy. So I think, again, it kind of goes back to what type of return are you trying to generate? The long end of the curve, yield-focused investors, I think, still a really good entry point. And total return investors focusing on that intermediate and short end of the curve to pick up on some of the, markets recalibration around Fed expectations going forward.
And speaking of, Amanda, you say that the driver for the next Fed rate cut, or the first Fed rate cut that we get, is going to be more important than the actual cut itself, at least in your universe. If the driver is a more fragile economy, a more fragile labor market, if that's, the reason why the Fed makes its move, then are you still happy to go down the credit universe?
Yeah, so I think Maureen nailed it. The yield-based technical bid is incredibly strong. And so if we have deep Fed rate cuts because of a deterioration in the economy, that erodes some of that yield premium that is existing for corporate credit investors to buy. I think if we were to have a severe downturn in the economic backdrop or severe deterioration in the labor market above and beyond the weakening that we've already seen, then you should expect a rebuild of risk premium. Right. And I think that is not something that is our base case, but it's definitely a risk that we're watching. We're watching this feedback loop between company margins, the labor market, consumer spending, and overall economic activity. So it will really depend on that. Ideally, the best case for credit investors is a normalization of monetary policy because inflation is cooperating, and to kind of head off additional weakening in the labor market. That would be the most ideal outcome. Heading into Jackson Hole next week, we'll be watching for Fed Chair Powell to talk about the risks to the dual mandate. I'd like to see him clarify whether he's still emphasizing the unemployment rate over the number of payrolls added in any given month, and then also commentary on the neutral rate. Big difference between normalizing and easing, and we're not expecting easing at this stage.
Maureen, let me ask you, it's perhaps a little bit oblique to this market, but if we do see some kind of a breakthrough, whether it's a partial ceasefire or a ceasefire or something that comes out of the Putin-Trump dialogue, does it have any impact on your universe, US corporates? I mean, even if sanctions are lifted, does it have an impact?
I never like to be cavalier about geopolitical risk, but generally speaking, that is more of an equity market story than it is a credit market story. So I would like to say that perhaps you get a little bit of a tailwind in just broader macro sentiment on the back of any ceasefire arrangement. But I think unlikely that we see that show up in a material way in terms of spread direction in our market. I think it's going to be largely technically driven from this point on. We're sitting at 75 on the index. That's the new year-to-date tights. We're only a basis point off of the multi-decade tights. So hard to see how much tighter we really go from here. So again, I don't want to dismiss geopolitical because always when something can arise and derail our market pretty meaningfully. But I think in this instance, it's probably our market's pretty well insulated from some of that headline traffic.
And as macro, you would say the same thing, Amanda?
I think it just goes back to this view on there are two-sided risks in this market that we need to navigate. It feels like the market narrative in any given day kind of ebbs and flows towards one direction, but there are both positive and negative risks that we're monitoring. I would say deregulation, the fiscal spending, perhaps an easing of geopolitical tensions. I would put those firmly in the potential positive buckets, and then potential margin pressures in the negative. But actually, I think it's a pretty constructive environment so long as you do kind of the back to basics credit work on these corporate borrowers.
It might be more of a sentiment driver than anything else. Thank you to you both. Fascinating conversation there. That is Amanda Lynam of BlackRock and Maureen O'Connor of Wells Fargo. And if you can't get enough talk on credit, who can? Please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. Still ahead, the final spread, the week ahead, retail earnings, world leaders meet, and it's the Fed's annual Jackson Hole Symposium. This is Real Yield on Bloomberg. Time now for the final spread, the week ahead. Coming up Monday, Bloomberg sits down with Fed Governor Michelle Bowman as we kick off our week of coverage out in Wyoming. Tuesday, a big week of retail earnings kicks off with Home Depot. Plus, there's a SALT crypto conference. Wednesday, earnings from Target, minute from Fed's July meeting, and UK inflation data. And Walmart earnings Thursday. Of course, the Fed's conference in Jackson Hole kicks off. And then Friday, it's the big one. Fed Chair Powell speaks in Jackson Hole. From New York, that does it for us. Same time, same place next week. This was Real Yield on Bloomberg.